A lot of business owners form an S Corp because they hear it can save on taxes. And that can be true, but then something frustrating happens. They have the S Corp, they are running payroll, they are taking distributions, and tax time comes around and they still owe a big tax bill. So what happened? Was the S Corp a bad idea? Not necessarily. That problem is that of an S Corp is not a complete tax plan. It can be one piece of the plan, but it does not automatically solve income taxes, estimated taxes, deductions, retirements, or year-end strategy. So in this video, I want to explain why business owners can still owe a lot of tax with an S Corp and what should be reviewed if you want your S Corp to actually help you keep more of what you earn. Before we get into it, make sure to like this video, subscribe to the channel, and download my 5-step year-round tax planning checklist using the link in the description below. It will help you stay on track to keep more of what you earn. The first thing to understand is this: an S Corp does not eliminate income tax. That surprises some business owners. The S Corp can potentially reduce certain payroll taxes or self-employment taxes depending on how the business is structured and how much reasonable salary is paid. But the profit of the business still generally flows through to the owner's personal tax return. So if your S Corp earns a profit, that profit is usually still taxable to you. Even if you leave some of the money in the business, even if you don't take all the money out, even if you reinvest some of it, that is because S Corp income generally passes through to the shareholder. So a business owner might say, I only took $80,000 out of the business. Why am I taxed on $150,000? The answer may be that the business had $150,000 of taxable profit. That is why the S Corp does not automatically prevent a big tax bill. It may change the type of tax you pay, but it does not make the taxable income disappear. The second issue is misunderstanding what the S Corp is designed to save. When people say an S Corp saves taxes, what they often mean is that it may reduce Social Security and Medicare taxes compared to being taxed as a sole proprietor or a disregarded LLC. With an S Corp, the owner generally receives reasonable compensation through payroll, and additional profit may be taken as distributions. Those distributions may avoid Social Security and Medicare tax. That is where the potential savings come from. But that does not mean distributions are tax-free. They may not be subject to payroll tax, but the profit still usually flows through and is subject to income tax. So if your business profit is high, your income tax may still be high. For example, if your S Corp saves a few $1,000s in payroll taxes, that is great. But if your income is high enough, you may still owe a large federal and state income tax bill, especially if you are in California or another high tax state. So the question is not simply, do I have an S Corp? The better question is, what is my full year tax plan? The third reason business owners still owe tax is that their estimated tax payments are too low. This is very common. An S Corp owner may be running payroll and withholding some taxes from their paycheck, but the payroll withholding may not be enough to cover the tax on the S Corp profit that passes through to them personally. This is especially true if the business is profitable and distributions are being taken during the year. The owner may feel like taxes are being handled because payroll is running, but payroll withholding and estimated tax planning are not the same thing. You still need to project your total income. That includes wages from the S Corp, business profit, spouse income, investment income, rental income, and any other income. Then you need to estimate the total tax and compare that to what has already been paid through your payroll withholdings and the estimated payments you made. If that review is not done during the year, the result can be a really big surprise when tax bill comes around. That is why I like to review tax projections during the year, not after the year is over. By tax season, we can report what happened, but during the year, we can still adjust withholdings, estimated payroll, and some planning strategies. The fourth reason business owners still owe too much tax is that deductions may not be set up or documented correctly. Business owners often hear about deductions like home office, vehicle expense, business mileage, cell phone, internet, meals, travel, equipment, health insurance, and retirement contributions. But knowing that deductions exist is not the same as actually capturing them correctly. For S Corp owners, this is especially important because some expenses need to be handled through the corporation. For example, if the owner personally pays business expenses, the S Corp may need an accountable plan to reimburse the owner properly. If that is not done, deductions may be missed or handled incorrectly. Health insurance also has special rules for S Corp owner employees. Retirement contributions need to be coordinated with payroll and the plan. Vehicle deductions need documentation. Home office deductions need to be handled carefully. So if the business owner is just waiting until tax time and trying to pull everything together from memory, there may be some missed deductions. That is another reason the S Corp may not produce the savings the owner expected. The issue is not that the S Corp failed. The issue is that tax planning system may not have been completed. The fifth issue is retirement planning. For many profitable business owners, retirement planning can be one of the biggest tax savings opportunities, but it does not happen automatically just because you have an S Corp. You may need to set up the right retirement plan. You may need to coordinate distributions or contributions with payroll. You may need to review whether a solo 401k, a SEP IRA, a simple IRA, or another plan makes sense. And depending on the business, employees, spouse involvement, income levels, and goals, the right answer can change. That matters because retirement contributions can reduce taxable income and help the business owner build wealth outside of the business. But if this is not reviewed until the tax return is being prepared, it may be too late for some options. So when an S Corp owner says, "Why do I still owe so much tax?" one question I would ask is, did you review the retirement planning before year end? If not, that may be a big missed opportunity. The sixth reason is probably one of the biggest. The business owner may be doing tax preparation but not tax planning. Tax preparation looks backwards. It asks, what happened last year? Tax planning, on the other hand, asks, what can we still do before the year is over? That is a big difference. If you only talk to your tax preparer during the tax season, then most of the year has already happened. At that point, the main job is to file the tax return correctly. But proactive tax planning looks at things like, what is your projected profit? Is your S Corp salary still reasonable? Are estimated taxes on track? Are distributions being handled properly? Are deductions being captured? Should we adjust payroll? Should we review retirement contributions? Should we consider equipment purchases? Are there year-end moves that we need to happen and make happen now? That is why tax savings are usually found during the year, not after the year is over. So if you have an S Corp and still owe a big tax bill, it may not mean the S Corp was wrong. It may mean the S Corp is not being used as part of a full year tax planning process. So let's use a simple example. Suppose your S Corp has $200,000 of profit before paying you. You pay yourself a reasonable salary, you take distributions. Maybe the S Corp does reduce payroll taxes compared to being taxed as a sole proprietor, but if you do not make enough estimated payments, you can still owe a large amount when the return is filed. If you did not reimburse yourself for legitimate business expenses, you may have missed those deductions. If you did not review retirement contributions, you may have missed a major planning opportunity. If you did not look at your total household income, you may have underpaid taxes during the year. So the S Corp may have helped with one part of the tax picture, but the rest of the picture still needs planning. That is the key point. An S Corp is a tool, it's not the entire plan. So why do business owners still get big tax bills even with an S Corp? Because an S Corp does not eliminate income tax. It may reduce payroll tax, but not all taxes. Estimated tax payments may be low, deductions may not be set up or documented correctly, retirement planning might be missing, and the owner might be relying on tax preparation instead of year-round tax planning. The bottom line is this: if you own an S Corp, the question is not just whether the S Corp was formed correctly, the question is whether the S Corp is being managed as part of a complete tax planning strategy. That means reviewing salary, distributions, payroll, deductions, reimbursements, retirement planning, estimated taxes, and year-round strategies before it's too late. If you are an S Corp owner and you are not sure whether your S Corp is actually helping you save taxes, download my 5-step year-round tax planning checklist using the link in the description. And if you want help reviewing your S Corp salary, tax savings, and overall tax planning strategy, book a call by using the link down below that links to our website. Thanks for watching, and make sure to like this video and subscribe for more tax planning strategies for small business owners. I'll catch you on the next one.